All right, welcome back to Lunch at the Market. Today we're answering at Jay-Z, at, it sounds like Jay-Z, right? At JZZ's request. I think that's a StockTwits symbol or a StockTwits username. We're going to answer their requests regarding how do you short stocks like Amazon, Apple. The question was, if I want to short Amazon, Apple, what is the safest way to do it? Now, stick with us through the whole show so we can get you through to the bottom line but our first response is, are you nuts? Why would you short something like Apple or Amazon? Do you want to get your face ripped off? All right. Now that I said that and hopefully warned a few people and that you think twice before you do such a thing. All right. Look, these love you, hate you stocks are on everybody's hot list and everybody wants to know, when they're going to roll over, when's going to be the end of the run, right? Certainly today, Netflix is taking it on the chin. I think it's down about $7 or about 3%. Look, there are moments in time to be short these names. I think at TradeFast did an excellent job being short yesterday in the aftermarket on Netflix and then covered today when the stock opened up down massively. Okay, so there are moments in time when you can short these stocks, but do you really want to be short in a Priceline.com like short call spreads? Right, that was one of the questions they had is, we usually sell put spreads because we're bullish on things. If you're bearish on something, should you sell call spreads? If you're bearish on something, you can sell a call spread. But, let's take a look at Priceline.com, ticker symbol PCLN, over the last 5 years. If you would have shorted Priceline.com over the last 5 years, you would have been right about 4 times for a total of 3 or 4 months. You would have been wrong about 1,000 times for about 4.5 years. So please, on these love me, hate me stocks, just be really, really, really careful trying to catch the money from the short side, okay? The valuation is always an issue, and everybody says that, and everybody's in awe, but yet they go up. And they go up because these business models are game changers. Netflix is a game changer. Amazon.com is slapping Walmart like a redheaded stepchild, okay? These business models change the face of how consumers do business forever. Okay, something like 20% of all internet traffic after 6 p.m. is directly attributable to Netflix. Okay, please just be really, really careful with these love me, hate me stocks because you love it if you're long and you hate it if you're short, and then you hate it if you're short and you love it. Okay, just be careful. Now, that being said, there are appropriate times, for instance, ahead of earnings in which you want to take a bearish bet. So let's walk through that. How do you do that? Now, look, they don't give out medals of honor for getting into a stock short at the top. Okay, so giving up a few points on the downside is probably worth it to avoid getting your face ripped off. Okay, when you're in a healthy uptrend, these stocks have pulled back absolutely violently and then rocketed back up the other way. For instance, every single decline in Netflix has been met by right, Newton's law of motion or something. For every action, there's an equal and opposite reaction. Well, in the case of Netflix, it's not equal and opposite. It's greater and in the opposite direction. So again, just want to caution you. But take, for instance, Amazon's earnings. Mike Coe had a fantastic put butterfly that he showed us on options action. We put the trade on over here at Magnum Opus Financial. The stock absolutely gapped down after reporting earnings and went down, and then there was a level at which it stopped, boom, hit support extremely hard, and then started to trade back up. For Amazon, I think that was the 168 level, so 170 was your line in the sand. The stock broke it about 3 times, but then by the end of the day, for about 2-3 days in a row, the stock refused to give up that 170 level. As soon as it, that was in there, the stock took back off and went the other direction. So what did we do? We had that put fly on. Remember, we were short 175.70, and then there's a put spread below that you're short at 170, 165. And so what we did was we actually, as soon as the move happened, that first flush, we took off the long put spread. We took our profits on that because when Amazon failed to break that 170 level over and over and over again, I felt really comfortable being short those spreads. So we left those on there. We actually added to that position, and then we took off the top side of that. We sold that, and then sure enough, the stock traded back up, and now we've got a profitable position on both sides of the trade, on both sides of the put butterfly. So a put butterfly, I think, is the safest way to play it. it really lowers the cost of being in the trade from the short side, meaning this short put spread that's part of the put fly really lowers the cost on this long put spread right here, right? So you're paying for this option, you're paying for this option, but these options, right? So you're doubled up here. You have an amount here, say 2 spreads, you got 2 spreads here, and then this is 4. Two on this side and then 2 on this side for a total of 4. So it looks like 2, 4, 2. That's how you do a put butterfly. Long to here and then short in this spread. Okay, hope that helps. I know you love these incredibly high-tech finger charts that we do here at Magnum Opus Financial, but until we get a bigger budget, right, you get what you get. But at least the information's good. All right, so in the case of Apple, I actually think there's a good reason for doing a put butterfly on Apple. Why? Because Steve Jobs can't live forever. We sent out an article about pancreatic cancer, and the reality is that you pretty much get 5 years with that thing. This is the 3rd medical leave of absence that Steve Jobs has had, and despite the amount of unlimited budget that he has to put towards end-of-life care or extending his life, the reality is that everybody says goodbye at some point. And when it does, Apple is going to get whacked. So consider, and you probably want to go out in time on the calendar on this one, because who knows when this event happens, right? But the risk is out there that it does. And so you can take advantage of any unknown catalyst to the downside from Apple at the same time that you protect yourself against the inevitable death of Steve Jobs. Okay, consider getting long the 350-300 put spread. Now, why so wide? Well, because the reality is that if Steve Jobs passes away, you're likely to see like a 20% decline in the stock like that. And so you're probably talking about a $50 or $60 decline in the stock. On the long side, or on the short side of it, consider being short the 300-275 put. So I'd say do this in June, July, August, September. Go out on the calendar for some time. In fact, if you go out far enough on the calendar, you might even be able to double up the size of your short put spreads, and then significantly reduce the cost of your long put spread. Does that make sense? Okay, so let's say you could do 1/2 or 1/3 or 1/4, and then you'd be short put spreads at the 300, 325, which are quite out of the money at this point, but wouldn't be terribly out of the money, or maybe even slightly in the money if Steve Jobs passes away. Well, it's not really if, it's kind of when. Okay, so that's a great way to think about doing a put butterfly on Apple, right? Your long 350-300 put spread, it's a huge spread, and obviously you stand to make an enormous amount of money if this thing comes to fruition. Just by itself, you'd probably pay about $1,500 for that spread, for that long put spread, but it's worth $5,000 if the thing happens. Okay, so consider doing that, and then again, to subsidize the cost of that, look, Apple's an amazing company, and no matter what everyone will say when Steve Jobs passes away, they'll say the company's done, it'll never be the same again. It's got an incredibly deep bench, and guess what? This is the 3rd medical leave of absence, and they've managed to run the company and grow the company during every single break. They have an unbelievable product slate. They really are a minority in every market which they serve, right? They are not the #1 smartphone in the market. They are not the #1 laptop in the market. They're not the #1 personal computer in the market. And so the reality is they have a huge amount of profit or of market share that they could take, which is going to be fantastic for their bottom line. So they have a lot of way to grow, but the inevitable fact is that something will happen to Steve Jobs, and when it does, it's going to be a massive hit to the stock. So this strategy can be used to protect against an unknown event that you think is just looming out there and you're just absolutely sure it's going to come, like a death of Steve Jobs, or right ahead of the quarter in case it pulls an F5 and gaps down massively, right? You take advantage of the decline, and then the hope is that you pick you're really appropriate and you watch your levels, and then this short put spread. Look, if you get in trouble on this part of the put fly, just roll it down and out. A stock like an F5, an Apple, an Amazon, an IBM, all of those stocks have fantastic businesses, which means that there's a level the stock won't go to on the downside. All right, hope that's helpful. Thank you at JZZ for writing in. Remember, you too can write in and get your question answered on Lunch of the Market. Thanks for joining us today. Have a great day, and we will see you tomorrow.